Hello, Jax. Fahad here. Amazon will be reporting earnings on Thursday, January 31st after market close. And I'm sure I will get a ton of questions from clients about positioning, about what to do, how to play, and so on and so on. So I want to take this moment and give you some high-level thoughts around the company and what I've been seeing in the checks. Starting off, here is a comment that I posted in the Q1 Outlook, Jaguar first quarter Outlook, that went out to the clients on January 2nd about the state of the overall cloud spending environment. The issue at heart is industry's discussions indicate that the US hyperscalers are entering a period of consumption after many years of investment. And this will sharply clip the growth rate of cloud capex from 45% in 2018 to just 5% in 2019. This particular view actually was first stated by JP Morgan in its research report, and after digging around too much, I found out to be quite interesting. Here's a chart from JP Morgan. Take a look at this cloud capex trend. 2016 up 24% year over year, 2017 32%, 2018 45%, and then the cloud capex growth just crashes in 2019 down to just 5%. Is this going to happen, or is this just a theory? Let's take a look at Intel earnings report that came out last week on Thursday. I went in, I pulled the entire transcript, and I was going through the Q&A session, and here's a comment that comes from the Intel data center GM, Naveen Shenoy, on Thursday last week. The signals we get from our customers is a period of build for compute is going to shift now to a period of consumption. And that started in the second half of the fourth quarter, and we expect that to continue through the first half of the year. In the same conference call, here's a comment. This time comes from Intel Head of Investor Relations, Mark Henninger. Cloud service providers shifted from building capacity to absorbing capacity, and the demand pricing environment has further deteriorated. Now, in case if you do not know, Intel sells a lot of chips into the data center businesses, and these data centers are mostly used by cloud service providers such as Amazon, Microsoft, Google, Apple, and so on and so on. Now, Intel is telling you that the cloud spending environment on the chips have slowed dramatically. But what you're noticing here in both of these comments is exactly what we said in the Jaguar first quarter outlook, which was that we are essentially entering, after 3 years of heavy investment build years, we are now entering into a consumption years. Therefore, the inventory levels on the chip sales are starting to rise, and we're seeing moderation in overall cloud capex environment as a result. Here's a picture from Intel earnings report. This is the fourth quarter of 2018, and this is the fourth quarter of 2017. Doing a year-over-year comparison, you can see the data center business prior year was a massive beat. Overall absolute growth rate was 19.1% year over year. In the current quarter, in the quarter that was reported last week, that growth rate basically clipped in half, only up 8.7% year over year. A day after the Intel earnings reported earnings, now quick background on Intel reports, one of the comments that Intel stock probably should have been down more like 10 to 15%. Let me just put it this way, instead of let's say 5 or 6%. But the reason why it wasn't, in my view, is because the company said in its conference call that they will be releasing Cascade as well as another chip program in the second half of 2019. So they expect that the cloud spending environment will continue to deteriorate in the first half of 2019 and then pick up in the second half of 2019. However, here's a comment from SunTrust analysts that disagrees with that. They say, we believe management full year expectation for mid-single digit year-over-year data-centric growth implies an overly aggressive DCG acceleration in the second half of 2019. We believe 2019 earnings may fall year over year. I can tell you this: there's not a single analyst out there that is expecting that is expecting Intel to post year over year growth decline going forward from here. This is the only one, and I believe this analyst will end up being right because of exactly how we are seeing deterioration in overall cloud capex environment, because we are going from investment build year to a consumption year. That was the first point. Now to the second point about Amazon before it reports earnings. Overall, on the cloud side of the things, keep in mind that this is the trend that we are seeing. The 2016 to 2018, we saw the total cloud capex environment jump from $52 to $95 billion. And then take a look at the last three-quarter trend. 2018 was, second quarter 2018 was up 66% year over year, decelerated to 32% year over year in the third quarter 2018, and now is expected somewhere in the high single digits to low teens in the third quarter or in the fourth quarter of 2018, and then we'll see what the 2019 looks like. On the second part of Amazon, that has to do with the online retail sales. Of course, the discussion would be incomplete without touching on that. This goes back to a slide that I presented about Walmart when I made a presentation at the AAII conference in Las Vegas last October. Last quarter, which is the third quarter we're talking about here, Walmart e-commerce sales were up huge 40% year over year, which was 4 times faster than Amazon growth rate, which slowed to only 10% from the mid-teens in the prior quarter. Walmart is not the only one that has having a lot of success with this omni-channel after several years of build out. Here's another picture. This one comes from a most recent survey from Bank of America that was done last week, in which they compared Walmart to Amazon, looking at asking the surveyors, have you used the platform in the past 6 months or not? Naturally, Amazon remains quite high, above 90%, but there was a significant 1,000 basis point increase from the third quarter to fourth quarter in Walmart. I believe this is trying to tell you something. Amazon is consistently strong, no question about it, but Walmart and Target and others are finally starting to see significant amount of success after several years of omni-channel build out. Here's another picture. This one comes from a file that I shared from the big box retailers in November last year. And this goes to show how Amazon online retail sales have decelerated, and at the end of the third quarter it was only 10% year over year after has as much as 20-25% in the prior quarters. Meanwhile, the digital sales of both Walmart and Target have continued to gradually move higher and higher and higher. By the way, here's a Target chart. It's a beautiful looking chart. So inverse head and shoulder formation, setting up for a breakout from $73 per share. If it breaks that out, I believe it goes to 75 first, and then it goes to 82. Just showing you some gaps that remains to be filled. Also, last Friday, Target saw a massive buyer of 12,000 contracts of July 82.5 calls for $1.63 offer. Almost $2 million bullish bet. Now should be reflected in the open interest on Monday. So keep that in mind. To put this on perspective, what does all of this mean for Amazon? Basically, Amazon has two businesses, right? Amazon is cloud, AWS, and the online retail sales. On the cloud side, if JP Morgan is even half right about the cloud spending environment, capex spending environment coming down harsh, then, and it seems to be right because data center business from Intel is telling us that already. And so that part is growing and is slowing. And the second part is the online retail sales. And we know that Amazon, Target and Walmart and several other retailers are starting to have tremendous amount of success with their omni-channel program. So Amazon growth rate is decelerating there as well. Two big pieces, and both of them seems to be in a downtrend. Both of them seems to be decelerating sharply, and I think that earnings report that comes out is going to reflect that. Particularly the guidance will also reflect that. But make no mistake, I'm not making this video to suggest you go outright and short Amazon. That's not the objective over here. It's a great company, and the most likely scenario at this particular time is that Amazon will probably enter into a phase of long-term consolidation. It's not going to make a ton of money for the bears or the bulls, but rather a large digestion phase. It's probably already in it. What I mean by that is, let's take a look at Disney, for example. Disney had a massive run all the way up until 2015. And then it went into a 4-year consolidation phase, 3 to 4 year consolidation phase. It's still in it. It hasn't really been able to break out through that. Disney had different issues related to ESPN, cord cutting, basically events that caused the investors to reevaluate their sentiment about a particular stock. And they want to see better growth, better estimates to come out before you will see re-rating appear in a Disney stock. Starbucks is another good example. Starbucks went through the same exact period. Starbucks had remarkable growth in 2013 and 2014. And then went into a 3-year consolidation period before recently broken out. By the way, I believe the reason why Starbucks is breaking out is because I believe market is sensing that Howard Schultz is going to announce his candidacy for the U.S. presidential election in 2020. But that's a discussion for a different time. Important thing is that Starbucks went into consolidation once again also because of its growth concerns. In this particular case, the growth concerns was over congestion, stores being too close to each other, thus cannibalizing sales, and as a result, overall same-store sales had gradually decelerated from 6% down to 3%. And that's why the stock went into a consolidation phase. Why couldn't something similar happen to Amazon? And that's essentially the case over here. Amazon has had a couple of remarkable years, the last couple of years. And then starting from early 2018 or mid 2018, I should say, it really has been a large chop fest. Maybe this is a large channel between, let's say, $1,400 and $2,000 per share. Why couldn't Amazon just spend some time in this channel for the next couple of years, 2-3 years, and just consolidate while some new fresh worries will appear around the stock related to online sales decelerating, related to cloud capex environment softening? It is not a bear or bull case at this particular time as a result. It's rather more of a digestion story for Amazon than anything else. So the trade over here is not to go outright and short it or buy it. It's to rather basically buy it opportunistically when it pulls back, perhaps around $1,400, and then sell short when it rips higher to $1,800 to $1,900 per share. It's right now in the middle of the channel. And that's essentially the view over here. I could see layers of bear cases lining up against Amazon, but this is not the company one can bet against and make money to the downside very easily unless you're very quick with weekly put options or something. I think the best case scenario is for several quarters of nothing more than just a large giant chop fest and a consolidation phase similar to some other really good companies. One last slide I want to show is this particular one. This is the sales per share of Amazon. As you can see, going all the way back to last 10 years, sales per share, total sales per share. And this is price to sales ratio of Amazon. You can see even as the sales were consistently rising, it wasn't until 2016 when the price to sales ratio, meaning the valuation, didn't really actually materially expanded. And so basically went through the channel, went above the channel. It is still elevated. It is quite possible that Amazon will possibly continue to digest these gains for the last couple of years, and as a result you'll see valuation gradually come in and contract to a level where it was previously historically. Perfectly normal kind of a price action. That's it for me. Thank you very much.